It's that time of the year again when one needs to begin calculating their tax liabilities. However, before that one needs to analyze the various sections of tax deductions under the Income Tax Act. Apart from Section 80C, there are other tax deductions provided by the Income Tax Act 1961. 80C, Section 80C of the Income Tax Act allows certain investments and expenditure to be tax exempt. The total limit under this section is 1 lakh rupees. Included under this heading are many small saving schemes like NSC, PPF and other pension plans. Payment of life insurance premiums and investments in specified government infrastructure bonds are also eligible for deduction under Section 80C. 80D, Tax Deduction Section 80D qualifies for Mediclaim policies. The maximum amount allowed for exemption annually for self, spouse and dependent parents or children is 15,000 rupees. In case of a senior citizen, the maximum amount extends up to 20,000 rupees. 80DD, Expenditure incurred for the treatment of handicapped dependent, one could claim a deduction under Section 80DD. If the person is suffering from 40% of any disability, a fixed sum of 50,000 rupees can be claimed in a year. Similarly, if the disability is 80%, the fixed sum hikes to 1 lakh rupees per year. 80DDB, Cost incurred for treatment of specified illnesses could fetch you a tax benefit under Section 80DDB. If one has incurred expenses for the medical treatment of self or dependents, can claim a deduction of up to 40,000 rupees or the actual amount paid, whichever is less, under the Section 80DDB. For a senior citizen, the maximum exempted amount is 60,000 rupees or the amount actually paid for medical expenses. 80E, The interest paid on loan taken for pursuing higher education of self or any dependent is exempted from tax under Section 80E. This deduction is applicable for a period of 8 years or till the interest is paid, whichever is earlier. No exemption is applicable for part-time courses. 80GG, If a salaried or self-employed person staying in a rented house does not receive any kind of HRA, they can claim a deduction under this section. However, you cannot avail any such benefit if you or your spouse or your child owns any residential accommodation in India or abroad. 80G, One often donates a certain amount on philanthropic grounds to help the destitute. The exemptions can be up to 50% on 100% of the donations made. 80GGC, Any monetary contribution to any political party or electoral trust is eligible for tax exemption. 80CCG, the Finance Act 2012 introduced a new section 80CCG to offer 50% tax break to new investors who invest up to 50,000 rupees and whose gross total income is less than or equal to 10 lakh rupees. It has been introduced for budding investors entering the equity markets for the first time and is a once-in-a-lifetime benefit. Rajiv Gandhi Equity Savings Scheme is one such scheme which allows first-time equity investors earning up to 12 lakh rupees a year additional tax savings. Hence, there are several sections apart from 80C that can help an individual benefit from tax exemptions. It is time to start looking beyond 80C for tax savings. With Chalu Dubey, this is Salva Chaudhary, DD News.